Thank you, Tasia, and thank you, Kajenga Wellness Project, for inviting me to speak tonight. I am really looking forward to sharing a lot of useful information with everybody, and I hope that you get something out of this. I'm going to share screen with you. Before I do that, I would like to say that I know, Tasia, you have introduced me. My name is Sue Ann Baksh. You can call me Sue. It's probably a lot easier for everybody. And my pronouns are she and her. So I'm going to go ahead and share a screen here. And is everybody seeing that okay? Tasia, are you able to see the screen, or is everybody
Yes,
participating able
it
to
looks
see?
perfect.
We're good? Okay, great. Excellent. So as Tisha mentioned, I do have a financial background. In addition to working with the bank, I also have a nonprofit organization called Life to the Fullest. And as founder of that, I provide mentorship programs and services to individuals. And we all, myself and my husband, we offer communication skill builds and services to newcomers in Canada, and also some homeless outreach. So also to give you a little bit more information about myself on a personal level, I do also have, in addition to the nonprofit and working full-time, a for-profit business called Excel No Excuses. And in that business, we focus on creating a no excuses mindset through coaching and mentoring workshops to help individuals find success in their personal and professional lives. So as you can see here, just a few pictures to share of what I do out in the community. And then what makes me qualified to actually talk to you today. Anybody could come in and speak and share information about financial literacy. And of course, having so many years of working in the bank, you would think that, and a lot of people get a perception that a banker just has everything together and they're all financially stable. But from a personal standpoint, just to give you some history, my story is a little bit unique. So I was married for 18 years and in an abusive relationship. Myself and my 4 children are survivors of domestic violence. And after a period of time of separation and healing, myself and my children, we are in a better place. I'm now remarried in a very healthy relationship in a blended family of 9 children. So as you can see here, all the kids together. And, throughout my struggles throughout that toxic marriage, I actually faced a lot of financial struggle to the point of foreclosure where I almost lost my home. But having the benefit of the foundation of financial literacy and knowledge is what actually allowed me to navigate and helped me to come up with solutions and strategies to survive. And, being a mother of 4 who was now on a single income, and sometimes only having $40 for groceries a week, really had to find a way to provide for my family. So I'm not just a person who comes in with financial knowledge to teach, but when I say that I understand the struggles, I understand the struggles because I've walked that. I've walked that path. So that's what makes this a little bit more unique. We'll get started with our workshop today. And what I would ask is that this is going to be a bit of an interactive workshop. So I'd ask that everybody have a pen and paper handy for an activity that we will be completing together later on. And so what we're going to be talking about today in the workshop is the 5 principles of financial literacy. So according to the U.S. Financial Literacy and Education Commission, these 5 principles are earning, so how to make the most out of what you earn, savings and investments, and we're going to cover the 4 steps of savings, protecting, fraud prevention, and spending, establish smart spending habits, and then we'll look at borrowing, which is the power of credit scores and borrowing products. So what's really great about this workshop, and thank you again to Kajenga, is that with this parenting series, those of you can take these fundamentals and you can teach these to your children. Our kids don't always get an opportunity to learn this information in school. And so, by being parents and teaching our children these fundamentals and giving them this foundation, we are building generational wealth. So, you know, these are very, very important tools that they'll need. We're also going to cover a bonus segment, about inflation. It's the elephant in the room. Let's call it out. Inflation is talked about. It's what we're facing right now in the economy. A lot of us are struggling. There are families that are struggling, and so let's talk about that. The strategies and tips for coping with high inflation. Okay, so money. When we think of money, what comes to mind? There are so many things that come to mind. Money has such a huge impact on all of us in different aspects of our lives. And as you can see, there's many, many different topics and many, many things that we can think of when we hear the word money. And what is financial literacy? So financial literacy is the ability to understand and effectively use financial skills, including personal financial management, budgeting, and investing. And it's an important part of our financial life because knowing how to budget, understanding these fundamentals, and allowing us to be able to spend and save smartly helps you reach your financial goals, get out of debt, and build your savings as well. And that's really what we want to focus on. So let's get started with principle number one, savings and investing. Did you know that 40% of working Canadians spend all or more of their net pay when getting their paycheck? Isn't that such a large number? And 44% of working Canadians are living paycheck to paycheck. That is almost half of our Canadian population. That's a staggering number. And again, given the current economic state that we're in right now, we know that this number is growing. So why do we save for the future? So I'm going to throw this out to the audience. Does anybody want to share why they think it's important to save for the future? You can throw your comment in the chat or you can unmute. So great. So I'm seeing retire with dignity, rainy day, for saving for emergencies. Yeah, for emergencies, illnesses, unemployment, planning for unexpected life experiences. Yeah, unexpected expenses, and leaving something for our children. Yes, leaving a legacy for our children, financial legacy. Absolutely. These are all great answers. Yeah. So we want to feel more secure and in control. And as a few of you said, be prepared for emergencies, reduce stress and conflict. We want to spend with less guilt or fear. So that's financial security. Being able to afford major purchases, pay off debt and avoid new debt, and retire comfortably. So great. So let's get into the 4 steps of savings. The first step is to set up an emergency fund. So again, that was our number one response from most of you. And yes, experts say that you need to be able to support yourself financially for at least 6 months without an income. So how do we do that? You want to pay yourself first. The way that you do that is you set up your paycheck and you make sure that you're paying yourself. So you always want to make sure that you do pay your bills first, but you want to also set up a bit of an emergency fund. And the way that you do that is you do not spend every dime that you earn. Keep that in mind. So your paycheck comes in, and what you would want to do is allocate or set aside a certain amount based on your payroll schedule. So, for example, if you get paid biweekly or semi-monthly, you would set up an automatic savings. So, set up a separate savings account, and then on the day that you get paid, you would set up a set amount that automatically transfers from the account that your pay goes in into a separate savings account. So, it's gone and done. As you can see here in this example, if you had a good goal is to save about 5 to 10% of what you earn of your take-home pay, and so that's after taxes. And in this example, if you're earning $2,000 a month after tax, if you save 5%, that would be $100 a month, which equals $1,200 a year. Look how easy that number can jump, right? And if you're saving 10%, that's $200 a month, which equates to $2,400 a year. So that's how easy it can be to set aside a savings. And again, make the savings automatic. So you're setting up a direct transfer. A lot of financial institutions offer this service. You can even do that online nowadays or through mobile banking, where you can set up a recurring transfer. And then that money, you set up your date and you set up your time frame, and then that money will automatically come out of the account. And set it up so it comes out again on the day that you receive your pay. That's very key. The next step is looking at the different types of savings and investments account. And I just mentioned setting up a separate savings, but what does that really look like? There are so many different types of savings and investments account that are out there. So let's take a quick look at the breakdown. And what we want to consider and think about is that there are different types of savings, and each type of savings account does different things. So a regular savings account is just for parking funds. There really is not a lot of interest that's earned on that account, but it may just be for a short-term goal. So, saving for maybe a gift for somebody or for a vacation. So you just want to put some money aside. You can open a savings account and just park your funds. A high interest savings account is maybe for a little bit more long term. If you're looking for something that you're saving for a particular goal that's about a year or two, and you want to earn some higher interest. Higher interest savings accounts that are offered by institutions sometimes offer a bonus rate. So if you're saving for more than a year, the interest rate will be higher than if you were saving for 30 days. So sometimes they have a staggered interest account feature where parking funds in the account for 30 days, and then you can park a different amount in the same account, but under a 60-day window and the 365-day 1-year window, and the interest rate is staggered that way. There's also TFSA. We hear a lot about those. So tax-free savings accounts. This is a great way to set aside monies for tax-free contributions. This is money that you don't have to claim on your income tax. And there is a contribution limit that's set per year. So you would put that money aside. In TFSA, you do have the ability to earn a slightly higher interest rate than you do in the savings or the high interest savings accounts. So you'd want to speak to your financial advisor or your planner about what type of options are available to you. With an RRSP, registered retirement savings plan, this is more for saving towards retirement. This is more of a longer term goal. And so this also does help to reduce your taxable income by being able to claim those contributions on your tax return. Mutual funds, a little bit more of a high risk type of saving. These ones are good for medium to long-term growth. So 3 to 5 years is normally the best time to consider a mutual fund. The mutual funds, you can have different types of mutual fund portfolios. In these, you can have something that is low risk, anything that's high risk. So again, speaking to financial advisor about that, but that's another way to save your money and then earn some interest on your savings, potentially higher than what you would in any of the other accounts that I've mentioned here. And then once you're comfortable with mutual funds, you can also start looking at the stock market, which again is very high risk. This is when you're investing more into stocks and you're getting into investing into particular companies. But if you're looking to just start out, the recommendation would be to start with either a savings or a high interest savings account and tax free. Those are where you really want to start and then move on from. Great. So the next step is grow your savings. So again, investing in the stock market might be a more profitable choice. Again, that all depends on comfort level, your risk level, and your understanding of finance. And that's why these types of workshops are so important. You also want to contribute to any employer-sponsored savings plans. That may be offered by your employer or your organization. A lot of employers that will offer to match your contributions that you make up to a certain percentage. So leverage that because what you're actually doing is you're not only saving and putting money aside, but you're actually saving for your retirement and for emergency savings. And there are some features with employer savings plans where you may actually be able to withdraw some of those funds. But these are great to leverage because you become a shareholder in your company, you're earning more interest, there's shares, and there's what's called dividends. So the company pays out an interest or a dividend, and then that gets reinvested. So this is a great way to roll over your money and earn additional interest on your funds. And because your employer is matching, so for example, if you were contributing $50, your employer will contribute $50, and there you go. That's $100 that you've contributed to your plan and set aside for yourself. So it's a great way to grow your savings. Another way is to maximize your tax-deferred savings opportunities. So I mentioned those accounts just now, the tax-free savings, and also registered retirement funds. And then bonus is any extra monies that you get. So any gift money or tax refunds or a raise or a bonus, the difference of that raise or bonus, put it aside and save it as if you never had it. So that's another way of some lump sum savings that you can put aside for yourself. Principle number two is spending your money wisely. So it's really important to establish smart spending habits. You need to find a balance between spending and saving. And we want to distinguish between wants and needs. So as we know, we hear a lot about our needs and wants. So let's get into that as a refresher. A need is anything that is essential that one must have versus a want, which is something you would like to have. Remember that a need is something that's necessary to live and function, such as food, clothing, shelter, and medical care. A want is something that can just improve your quality of life, or it's something that you would like to have, but it's not required. So it's not a must have, it's a I want. It's a I would like to have. That's what the difference is. Great. So we're going to take a look at what your money personality is. And this is going to be our interactive part. So I'll ask that everybody grab their pen and paper now. So few people are 100% 100 or few people are 100% savers or 100% spenders. Most of us lean towards one specific type of money personality, and that starts to show fairly early in life, actually. So, what we're going to do is we're going to determine what your money personality is, because this is actually something that as it starts to show in life is actually what drives our decisions in when we're spending and when we're saving. So let's try to figure out what your money personality is. So what I'm going to do is I'm going to read out the question and I'll ask that once I read out the question, if it resonates with you, then please write down the corresponding letter. So in this case, once I read the first statement, if this resonates with you, you would write down the letter A and then continue to do so with all of the other statements. And then we're going to see which letter you have the most of. So I'm going to get started with that. All right. So the first statement is, I understand the difference between the things I want and the things I need. And if that applies to you, write down the letter A. And I'm going to take this with you and see what my money personality is. Next, I never return from shopping without having bought something. If I like something, I just buy it. I make purchase decisions quickly. If that's you, write down the letter D. I don't keep track of how much money I have. I like to have the fashionable and most up-to-date things. That's you. Write down the letter B. I spend little time planning for the future. I tend to overdo it when buying gifts for family and friends. The reason I want to have a lot of money is not to worry about money in the future. Shopping really cheers me up when I'm having a bad day. I always stay within my budget. When I go shopping, I plan ahead for the purchases I'll make. I get great joy from helping others. I do a lot of comparison shopping before buying a big ticket item. I usually spend money only on things that are really important to me. I believe money issues will work themselves out eventually. Money is my last priority. I get most joy from seeing my friends and family happy. I have things in my closet that still have the price tag on them. I buy the things I want when I want them and worry about paying for them later. Saving money makes me feel happy and comfortable. I would much rather have someone else handle my money. I have no problem going into debt or borrowing money for something I want. If I want something that costs more than my budget, I will save up for it. I am willing to loan money to friends and family in need. And the final question or statement is I will pay more for an item if it's by a sought after or high quality brand. All right, great. So what I'm going to ask is that everybody tally up their letters and let's see which letter you have the most of. So I'll give you just a couple minutes to do that. And then if you can throw your letter, the most high ranking letter in the chat, and then we'll take up your money personality. We'll look at what your money personality is. Okay, I'm seeing some A's. D and E, excellent. Okay. All right, great. So I actually had an A. Tasia, how about yourself?
Oops, sorry about that. I'm surprisingly an A, but it's because I just learned. I literally just learned that December.
Yeah, so a few of our participants are A's as well. So and we have a C also, some C's and D's and E's. All right, great. So let's take a look. What are these personalities then? All right. So the first one, saver, which is a majority of us, is someone who takes pride in saving rather than spending. You enjoy watching your savings grow and you'd rather not buy something than paying too much for it. You frequently choose less over more and you spend money, but you get more satisfaction from having money left over. So again, that's that sense of financial security. The issues with a saver, though, is you may find it hard to treat yourself on even spending on essentials or have trouble being generous with others. And you could be seen as a little bit stingy sometimes. And you could miss out on valuable opportunities and experiences because you're so focused on saving. For those of you who are B, you're considered the spender. This is someone who doesn't agonize over spending money and you love to give gifts. You just spend money as you get it. And it's that live for today attitude. You see every transaction as a deal, and you know when you see a good deal. But the issue with a spender is that you may have trouble saving and controlling your debt. You put too much emphasis on status, and your self-worth could depend too much on material things. So looking, to just spend without thinking. For a C, we had a few C's in the audience. You are the security seeker. So you like to play it safe, and before spending money, you need to feel that you've explored all your options. You don't like to borrow or lend money. You spend money, but get more satisfaction from adding to your savings. And the issue with the security seeker is that you may overthink, you may have some difficulty seizing opportunities or being spontaneous, and become overly focused on yourself. D's. There were a few D's in our audience as well. The risk taker. You guys are the risk takers. You tend to have an all or nothing mentality. You tend to see a deal in every transaction. You like to negotiate and you think a big potential payoff makes a calculated risk worthwhile, and you'd rather invest than save. The issues with a risk taker is that you may need some help setting limits when it comes to financial transactions, become impatient and gloss over risks and problems, and end up losing money because you are a little bit more risky in how you invest. The giver characteristics are focus and enjoy helping others. This was someone with the letter E. You are generous with your own time and money. You feel responsible for others' well-being, and putting yourself first is hard to do. The issues with the giver is that you may have a hard time saying no. You may ignore your self-interests and have wishful thinking. So this was a little bit different than the spender. So the spender is someone who just spends, but the giver is someone who is giving selflessly, but over giving, over generous at times, and not putting a limit, setting a limit and putting that in place by saying no. And next and finally, we have the flyer, mostly F. If you're mostly F, then your characteristics of the flyer are someone whom money matters, are of no interest to you. You like to explore and have new experiences and very generous with your time and your money, and planning ahead seems to be a drag. So the issues with the flyer is that lack of planning could cause problems because you're too quick to give control of your money over to others, and you're not acting in your best interests. And you also end up living beyond your means. So again, different from the spender, this is somebody who really is no limits. Just give, 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 spend, spend, spend. Great. So I hope you enjoyed that activity there. Now we have a better sense of how we spend. So again, for those of us, now that we understand our characteristic, you know that where your issues may be and how you need to, some of the things, the challenges that you may have in your characteristic and in your personality that you'd want to work on. Great. So next we're going to get into budgeting, which is another important step when it comes to saving and planning. So one of the core pillars of financial responsibility is budgeting. You need to understand where your money is going. And even business owners, they need to understand the importance of cash flow. We need to do that for ourselves as well. Because when we're not successful in understanding our budget and how our cash flow is, whether what's coming in and what's coming out, we really don't have a good sense of control of our finances. So really, essentially, did you know that 93% of Canadians who have a budget stick to it? That's actually a really high success rate, and that's why it's so important to budget. What makes up a budget is pretty simple. Three things. There's income, there's expenses, and out of that, the difference between the two, which is a surplus or deficit. And to break that down just a little bit further, Net surplus or deficit is the difference between your total monthly income and your total monthly expenses. Net surplus means that you have more income than expenses, and net deficit means you have more income, more expenses than income. So, with a budget, budgeting sheets are very easy to find. There's a lot of applications now that we have that we can use. So there's Microsoft Excel, Microsoft Forms. There's even Google Docs where you can create a budget spreadsheet of your own, or you can even search the internet for a budgeting spreadsheet. And basically, it's very simple. You just have one side where you would list all of your income and any monies that you have coming in. And on the next column, you're going to list all of your spending. And then you're going to total both up, total income, and total up all of your expenses, any money that's going out that you're spending on, and be very real with that when you're putting your budget together, right down to any subscriptions, haircuts, anything that you're spending money on, that's going to be an expense. And then the difference between the income and the expense is where you're then going to see whether you end up with that surplus or deficit. And you really do want to be in a surplus state because you want to be able to have more income, more money coming in than you are with money going out. And so let's take a look at the 50-30-20 rule. So what does that really mean? The 50-30-20 rule is a rule in budgeting. It's a technique that involves dividing your money into three primary categories based on your after-tax income. So we always want to work with your take-home, your after-tax or take-home pay. 50% you would allocate towards your needs, 30% is what you should be allocating towards your wants, and 20% is what you would set aside for savings and debt payments. Again, your needs, remember, are expenses that are necessary for your survival, which include housing, utilities, food and transportation, healthcare, and childcare. Third, the 30% you're allocating for wants would be anything that's considered a non-essential. So those are expenses that you allow to be personalized. It's self-care, eating out, takeout, any fun, entertainment, and things like that. And then the 20% of your take-home pay, which you're allocating for savings and debt repayment, is the breakdown. And that would, again, depend on your personal circumstances, but you want to be able to at least have 20% set aside, which you would include for your retirement contributions, any emergency fund, and anything for a goal, a particular goal, whether it's for travel, again, for retirement, or even if it was home ownership. Okay, so we're going to get into principle number 3, which is borrowing. So there are 3 key components of borrowing. The first one is principal, which is the money that you're borrowing. Number 2 is the interest rate. So this is the rate that the lender is charging you for the use of their money. And number 3 is the repayment term. So this is the length of time that it takes to pay that money back. There are different types of borrowing products out there that are offered. There's overdraft protection, credit cards, lines of credit, mortgages, car loans, and personal loans. So we'll take a closer look at these products. Overdraft protection. So what is overdraft protection? Oh, so let me go back here. Sorry. Overdraft protection is an overdraft. So whenever you have an overdraft in your account, that means that there isn't enough money in your bank account to cover a payment or a withdrawal that you have coming out. So overdraft protection allows you to have coverage for that transaction. It's a limit that's placed on your bank account. And this is the most standard type of borrowing product you can have. Overdraft protection helps you avoid any decline transactions or late payment charges and non-sufficient funds. What you need to be mindful of is that NSF fees or non-sufficient fund fees that are charged by the bank can be up to $50. And overdraft protection is less expensive as a short-term credit option. It's better than a payday loan. You do not want to be considering payday loans. So again, basically, this is just an additional limit that's on your account. For example, if you've got $100 in your bank account with an overdraft limit of 1,000, you now have $1,100 that's available to you to use. And again, it's a covered. So this is supposed to be a protection as it speaks, as the name says. So it just protects you from having any payments bounce or being returned, and just gives you that little bit of coverage that you need. What you want to be mindful of, though, and this is where a lot of people lose money, is on the fees, because the cost of overdraft protection can be quite high. And there are two ways that overdraft protection is charged. So with the charges, you're paying interest each calendar day on the amount you owe. So the minute that the account goes into overdraft, the interest starts to accrue and it starts to be calculated. And overdraft interest is normally between 19 to 22%. In addition to that, there is fees, and the fees are broken down either by a monthly fee or a pay-per-use fee. So at the end of the month, if you've used your overdraft protection limit, you'll see an overdraft interest charged, which is based on that 19 to 22%. So that's for how many days that your account was in overdraft. The interest is then calculated on that amount, and then you're charged that interest, overdraft interest. And then in addition to that, you're then charged a fee for using the overdraft. And so again, you want to be careful with the fees themselves. This is an example of an overdraft protection with a monthly fee. So as you can see here, the account had a balance of negative 50. So we've got an amount of 250 that's withdrawn. The account then went into overdraft of $50. A purchase was made at the store, and the account is now overdrawn by $75. And then there was another insurance payment bringing the account to $125 overdraft. With a monthly overdraft protection fee, you're only paying the fee one time, and that fee is normally $5. So as you can see, the fee was charged at the end of the month, and the account is overdrawn by $130. The difference with a pay-per-use overdraft is that it becomes more expensive. So the same transactions here, as you can see, 250 came out of the account. The account was overdrawn 50, but the bank now charges $5. As you can see here, the balance is starting to increase. The $25 was spent at the grocery. The account is now overdrawn by 80. $5 was charged for that, and now we're sitting at 85. The insurance came out, the account's at $135 overdraft, and a $5 charge. We're now at $140. So instead of $5 for the month, you've now spent $20. That's $15 in addition that you really didn't have, and that's been spent, and money you could have saved and used for something else. So be very careful with this. And if you find that you are under a pay-per-use system, then speak to your financial institution and have that changed to the monthly overdraft protection fee option. And that's one tip for saving some money there. The next thing that we want to look at is credit cards. So that's the next level up in borrowing. And did you know that making monthly credit card payments isn't enough? The fact that you aren't able to pay your balance in full shows that you already spend more than you earn. That's a red flag right there. And so there are so many different types of credit cards out there. Really and truly, the purpose of a credit card is to offer convenience for small purchases, emergencies, or even online items that you wanted to purchase. The charges are a loan, so keep that in mind. You are paying interest unless you pay in full by the due date. The charges add up quickly, so be very careful of that. And make sure that you pay the monthly balance in full if you're able. So again, this is supposed to be a short-term borrowing option. If you're going to buy something on your credit card, make sure that it is a small purchase. Try to keep it at a small purchase and make it so that you're able to pay that balance or pay what you've purchased in full before your due date. And choose a card with features that you want with the lowest cost. So make sure that it's something that works for you. Limit the number of credit cards that you have. Keep your credit limit low. and read your monthly statement. Make sure that you're checking to ensure that whatever's been charged on your credit card are valid credit card charges, and avoid any cash advances except for emergencies. Any cash advances that you do are at a different interest rate than they are for purchase interest. So, for example, if you got a credit card with a low interest rate on it, there are some financial institutions that offer that. You may have a, let's say, a 10.99 low interest rate credit card. When you make purchases, you're being charged at 10.99%. But if you are making a cash advance on your card, that could be as high as 22.99, 27.99%. So you see where the difference is there. Great. So pick the right card. There are so many cards to choose from. Choose the one that suits your needs and will work to your benefit. There are so many different types of cards that are being offered out there, rewards cards, and that's actually something that I myself leverage. So there are different programs that are out there that offer you rewards, whether it's dollar rewards or points that you can redeem and then turn into and redeem for merchandise. So that's actually something that I personally do is I do have a credit card with rewards, and it offers me uh, it's a point system. And then what I do is I accumulate those points, and at the end of the year, I actually redeem those points for gift cards, whether it's for gas, grocery. Sometimes it's a gift card that I'm just giving to somebody for the holiday. So that's money that I didn't have to spend out of my pocket. I've actually leveraged that reward system to do that. And also, in addition to rewards and the different types of cards and the interest rates, you want to also consider fees. So there are a lot of institutions that will charge fees with their credit cards. Again, there are pros and cons to that. It could be that they're offering you a reward with a lower interest, but then you pay the annual fee. So what you really need to consider is how much are you really spending on your credit card? And does that amount that you spend equate to what you're paying in your annual interest fee? Does it make sense to pay that annual interest over time? Also look at the value of any points or benefits being offered. Is this a rewards card that actually makes sense for you? Or are you just getting it because it's a reward card and it sounds nice? Make it work for you. Okay. Financial Consumer Agency of Canada actually has a comparison tool, and there's actually a lot of financial institutions now. If you go online, they have credit card selector tool, and you can choose based on your spending styles and the types of purchases that you make, and then it'll give you the options back as to which card might suit your needs best. The minimum for fixed payment. So let's take a look at that. So I mentioned earlier about paying your balance in full. Sometime, and banks are going to offer you a minimum payment that you can make versus a fixed payment. So when we're looking at this, for example, I'm just taking a sample of $3,000 balance that's owing on your credit card with an interest rate of 18%. So if you were to make your minimum payment, that's whatever's required, your statement comes in, it says pay this 2.5% every month. It's actually going to take you 263 months to pay off that $3,000 balance that you have. And the total interest you would have paid over that period of time is over $4,000. If you focus on making a fixed payment, which we talked about, allocating 20% of your budget to pay down your debt, and let's say you set aside $100 every month to pay this 3,000, you will have paid it down in 41 months, and you will have only paid $1,015. You see what a huge difference that makes in terms of time. How do we keep control of our credit card? Make sure you're paying your balance in full each month, and if you can't pay it in full, pay as much as you can. Don't make only your minimum payment and carry a balance. But if you're going to carry that balance, get a low rate card, transfer your balance to a line of credit. Line of credits offer a lower rate, and make sure that you're paying your balance within a few days before the due date. So now I've got a bit of a quiz for you. Let's see who was listening. Paying your credit card bill just a couple of days after the due date won't affect your credit report. Is this true or false? I just asked you to throw your answer into the chat there. Yeah, great. I'm getting some false. Excellent. Yes, it is false. So do not pay your card after the due date. This will impact your credit score. You always want to make sure that you're paying on or ideally a few days before your due date. Next question, true or false? If you use your credit card to take money out as a cash advance, you don't have to pay interest on the amount you've withdrawn as long as you pay your credit card bill in full by the due date on your statement. Okay, I'm getting some false. Let's see. Starts the day you take it? Absolutely, exactly. So cash advance, as soon as you withdraw the funds off your credit card, you will be paying interest on it. Okay, and one last question for you. Choose the best answer. Without a good credit history, your bank may charge you higher interest rates on a personal loan for a car or house. Your bank may refuse to give you a loan. You may not be able to get a lease on an apartment, one and two only, or all of the above. Excellent. Excellent. Thanks, everyone. Yeah, absolutely. The answer is all of the above. So credit history, your credit score is really, really important and can impact you, whether it's for a loan or for any other financial decisions that you're trying to make. 100%. Great. Okay, so we'll take a quick look at loans. So tips for managing loans. Remember to shop around. So a loan is, again, a borrowing product, but it's for a larger amount of money. You want to shop around and compare interest rates, stay within your budget, and borrow only what you can afford. That is the one of the most important key factors of a loan. Pay back more and pay back often. And additional payments mean you pay it off sooner and pay less. So with loans, there's two types of loans. There's personal loans and car loans. And a lot of times when I had clients come into the branch and ask me for a car loan, I would turn them away. I would literally say to them, go back to the car dealership and have a discussion with them and negotiate your interest rate on the loan. Because a lot of times the interest rate is a lot lower than it is than what the bank is going to offer you. A personal loan is more for consolidation or for, maybe for a small purchase that needs to be made that could have been for emergencies. But again, these types of loans are what we consider open loans. So when I talk about paying more and paying it often, just because you have a set term, so you may have a loan, borrowed funds, and it's over a 5-year uh, repayment term, you don't have to necessarily stick to that. You can actually pay extra towards that loan. That will actually save you interest over time, and then it will actually help you pay that loan off faster. So keep that in mind. If ever you're looking at a loan, always make sure to question that and ask, is this an open loan? And negotiate the interest rate. So just for a quick example here of how an interest rate of the interest works on a loan, you can see here that we have an interest rate of 4%. So in this case, Aria has to pay 4% of the amount that she owes, and this is the cost to borrow the money. Her repayment term is for 10 years, and the payment that she makes is monthly over the 10 years. So looking at this, $101.25 times the 10 years is actually going to cost her $12,150, and the total interest paid over that time is $2,150. So keeping that in mind. So she may have borrowed 10,000, but in total she's borrowed and needs to repay on $12,000. And This is my warning to you. I mentioned this early very briefly, is do not take out a payday loan. Payday loans are extremely expensive and they get you caught up because there are so many fees involved with payday loans. If you are looking for a short-term solution, seek out, as I said, any of the other options. Do not go for a payday loan. Their interest rates are exorbitant. They can go anywhere from 30 to 40%, and then there's fees. And I have seen clients get caught up with payday loans, and by the time that they've borrowed $1,000 with the hopes of getting paid in a few days and having to pay that back, by the time they borrowed the $1,000, paid the fees on top of it and any interest, they're practically giving back up to $1,200 of their payback, 12 to 1,500, and you just get caught up in a cycle. And so my warning to you is please do not ever try to avoid a payday loan. The interest rates are high and fees are too high. And then just for comparison, really quickly, we're going to look at the cost of borrowing of $300 over 14 days with the different types of credit products that we've discussed. So if we're looking at borrowing from a line of credit, again, we're looking at borrowing $300. I mentioned that interest rates are lower on a line of credit, and line of credits have larger limits than they do on a credit card. You then have overdraft protection on a bank account, cash advancing on a credit card, and then here, as you can see, the payday loan. So you can see the differences depending on the interest rates, how your interest and how your money is being spent. So ideally, if you've got carrying larger balances, you want to carry that on a line of credit because the interest rate is much lower there. So I also mentioned credit report. So what is a credit report? It's a summary of your credit history and other financial information that past lenders and current lenders are going to use to assess and collect data on how you borrow and what your spending habits are like. Why is it so important? It's a scoring system that gives a number between 300 and 900. The higher your score, the lower you're considered a risky borrower. Lenders use credit scores to decide whether to lend you money and to set the interest rate. And credit reporting agencies often charge a fee to give you your credit score. However, there is a way of getting your credit report once a year without having to pay for that. So the number rating basically indicates your credit worthiness at a specific point in time, and it indicates the risk you represent to lenders. Now, keeping in mind that the credit score is very fluid, it doesn't stay the same. It does get updated, and so it can change. So if your credit score is a little lower and you've checked your credit report and you understand why your credit score is low, you can work to improving that and bringing your credit score up. So maintaining a credit score is essential. Again, though each potential lender will have its own standards to what credit scores consider acceptable, the range is normally for good, very good, is between 725 to 760, and scores from anywhere in the high 600s to mid 700s are considered good, and that's really where you want to be. So don't go over your credit limit and always use part of your credit to have available. Build a longer credit history for yourself. Keep older accounts open if there's no fee. This is how you can maintain a good credit score. So you're not using the credit, but it's there. And use them, and I know this is a little counterproductive, but use it from time to time. So you do want to hold on to the limit as long as there is no fee. But again, just occasionally, just a small spend, $20, $25, and then pay it down, shows that you're using the credit and that you're paying it back. And don't make a lot of credit applications or do a lot of credit checks because this can drop your score. And always make sure that you're making your payments on time. Again, that's very key. And you just remember, use your credit wisely. So checking your credit report, as I mentioned, you can get a free copy of your credit report either by mail. Now it's online. Also, there's that feature. You want to review your credit report for any errors or accounts that are not yours and make sure that if you do find something that that doesn't look correct, make sure that you contact the credit reporting agency to report those errors and request a correction or place a note on the file. I have seen in some instances where the name of a father and a son are similar. So we've got a senior and a junior, but the credit reports have are mixed up because of the names being the same. And so they've had to have that corrected. So always make sure that you are checking even the finer details in the credit report. Okay, another question for everyone. Choose the best answer. Getting a copy of your credit report is a good way to check for identity theft. The only way to know if your report is accurate is free of charge if you request the report be sent to you by mail, or for all of the above. For absolutely. Yep, all of the above. That's great. Okay, and another question for everyone here. True or false? If you have applied for several credit cards or other forms of credit within a short period of time, this could have a negative impact on your credit score. True or false, everyone? Yes, absolutely. It's true. So again, if you're credit seeking and you're applying for lots of credit or constantly doing a lot of credit checks, it's going to drop your score because it does look like you're a credit seeker, and you could be considered a risky borrower, and that will impact you. Okay, so principle four, protect your money. We work really hard for our money, and so we want to be able to protect it from fraud. Did you know that 94.8 million credit cards were in circulation in 2022? And out of that, credit card fraud cost 800 million in Canada, $800 million. 39% of Canadians say they will not use their credit cards at certain establishments because of the risk of credit card fraud. Such huge numbers. And according to the Canadian Anti-Fraud Center, in 2022, fraud and cybercrime reports totaled 530 million in victim losses. Can you believe that? That is a huge amount of fraud. There are fraudsters out there, and this is their full-time job. So we really want to be very careful of this. We work hard for our money. We want to be able to protect it and keep it safe. So this is really important to share with our children as well too. There are a lot of scams out there. I know I get them on text. You know, we walk with our phones and we get them in text, we get them in emails. And this is a very common one that we'll see is an Interact e-transfer from the CRA. You know, if you click on the link, money will be deposited to you. I got one recently the other day. Hey, I've sent you some money. These are all scams, and actually clicking on those links could allow a hacker access to your phone. So you want to be careful of these types of scams. And also for those who are searching for jobs, be very careful and mindful of any bogus job ads out there. So if there's an offer for considerable pay, or a promise of high wages or wages in cash, and there's no physical address of the organization or of the contact person, and they're requiring you to send them a deposit or a void check in advance, do not do that. That is warning signs, red flags of a scam as well. Social media is a huge part of our lives, and there are so many different ways that and scams that are happening on social media. So be very cognizant of fake polls or links and apps. Download any malware. Doing that could try to download a malware protection set on your devices, because anytime there are times when you can click on the link and then it will download the malware or spam. Fake messages and phishing is very common. Asking you to log in to a fake site could allow a hacker to steal your ID, and also fake friend requests. So if you're getting a friend request on social media, make sure to check out the request. I've seen this a lot on Instagram where I get a friend request, but this person hasn't posted anything. So, it's not a real person. It's actually just a fake account. There's also been scams for fake money transfers or crowdfunding. You may be asked to help a friend by sending money. Be very careful of these types of things as well, too. Right. So how do we protect ourselves from fraud? Don't share your personal information. Make sure to shred any documents that you have. Keep your wallet or your purse safe. Keep it with you, but don't carry any ID on you that you don't need. If you have one of those household mailboxes and not the super mailbox, but a mailbox outside of your home, make sure that you lock it if possible. Again, limit the number of credit cards that you hold and make sure to check your credit report. Also, make sure that websites are secure. Delete any emails that ask you for personal information and that you have firewalls and spyware up to date. Don't give telemarketers personal information. And also with financial institutions, if you're getting a call from a financial institution, we will never ask you for your personal information over the phone. We will not ask you for your date of, well, we do ask you to confirm your date of birth, but we're not going to ask you for your credit card information, things like that, because we already have it on file. So there's no need for us to ask that of you. Save any bank records for at least a year. And if be skeptical, at the end of the day, if the offer sounds too good, it's too good to be true. What to do if you're a victim. So the first thing to do is contact your financial institution immediately. There is protocol in place for fraud claims. So that's the first thing that you want to do. Make sure to change all your passwords on your account, including any social media sites, and notify the two credit bureaus in Canada, which are Equifax Canada and TransUnion Canada. Also contact the Anti-Fraud Center and notify your local police depending on the level of fraud if you're aware of that or of any theft. So we're going to get into our strategies and tips for coping with inflation now that we've covered our principles and fundamentals of financial literacy. So again, I talked about the state that we're in right now with the economy and inflation, and it is a new year, and there's a common phrase: "New year, new you." New year, new you. And in every category of people's lives at this time, when the new year starts, we're thinking about ways in which we can improve our personal lives, our careers, our relationships, even our physical and mental health. And we're even thinking about vacations and planning for the rest of the year and considering our finances and what they look like and how are we going to get a handle on these finances. What's different this year is that people are carrying extremely high levels of debt on their credit cards. We've got mortgages, we've got high levels of high debt on lines of credits, and it's a real issue for people. And it makes sense because of the environment that we're in. People have mortgage renewals that are coming up this year, and they're going to be faced with a payment shock. We're no longer seeing those lower interest rates that we saw 4 or 5 years ago. The 2%. We're now seeing interest rates as high as 20%. There are interest rates out there like that. Um, and that is a shock. It's causing higher interest. And how are we going to be able to afford that? And although we've still got a pretty strong labor market, another big fear this year is what's happening because we're hearing so much news about layoffs as well. There's an increase in layoffs. And what we are seeing is that 38% of people are seeking out debt resolution services. And that's fact, given the environment that we're in. We're facing inflation, and it's a real concern of what's going on and what's going to happen in our economy. We're also seeing food banks. There's an increase in food banks, people using those services, and people are having a difficult time managing the debt that they're carrying, and it is making it more challenging for people. So, it's really important that we look at how do we get a handle on it? How can we manage that? So we'll take a look at that. So, did you know that debt is actually just a symptom? It's a symptom. There really are a lot of root causes that cause debt. So although we see an increase in interest rates, we are still seeing an impact with food prices And although we need to be aware that there are root causes that lead to debt, regardless of the economic state, there are root causes such as mental health, addictions, relationship breakdowns, and physical issues. And this is an issue. These are the real issues that are causing debt. So, in addition to the inflation and being able to get things under control in terms of the increased food prices, we do have additional factors we have to be mindful of, which are these added factors, and these are actually root causes. So the key to financial management is being able to identify what the root cause is and then make changes that help us to enable and then sustain that change. So we're taking a look at Maslow's hierarchy of needs. I'm not sure if everybody's familiar with this, but Maslow, it's the basis, it's a psychological hierarchy or a priority pyramid. And in the pyramid, what we're seeing is that we have certain needs that we need and that help us establish ourselves to be feeling safe and secure. And from a psychological standpoint, what are those needs? So there's physiological needs, safety and security, love and belonging, self-esteem. When we relate that to a financial standpoint, basically what we're looking at, we convert that into our priorities. So think about that. What is my number one priority? This is the same discipline that applies to debt and that we can apply to cash flow. So we're asking ourselves, what are you earning? Are you earning more than you're spending? Right. So we want to start with our basic need, which is cash flow and basic needs. So are you spending? Are you earning more than you're spending? If that's yes, then you want to move to looking at debt and focus on eliminating the debt down to $0, right? So then once you get from cash flow and basic needs, you want to move into the savings. When you move into the savings, you start looking at the tax vehicles like the TFSA and RSP that I mentioned earlier, and then moving into investing. Right? People try to do too much sometimes. So the number one thing to do is to focus on earning more money or cutting down on your spending until you can move up to the next level. So again, starting with your basic needs and taking a look at your cash flow before you then start moving into how can I then save. So by doing that and looking at the basic needs, there's something called the ABC strategy. It's what we call that is the analyze, brainstorm, and commit. So again, looking at the cash flow, that's your number one basic step. You need to be cash flow positive or you really can't do anything. You need to have a surplus, as we talked about in budgeting. Surplus is what helps you move towards your plan. You want to create a sustainable spending and you want to find ways to live sustainably. So that's the first thing to do is analyze what's going in and what's going out. What can I cut? Does it have to be that latte every day? Is it takeout food every, once a week or twice a week? Use your willpower, reduce these expenses. Maybe it's a subscription to a channel that you're streaming. So, what is your spending issue? Understand what that is so that you can become cash flow positive. And this applies to everyone, not just those who are facing financial struggles. And then you want to brainstorm. So, you've analyzed, you've brainstormed, and now you're going to commit to that. The next thing you want to also ask yourself is, what do I want for my life? This is a value-based question. Do you want to retire? Is it a house that you want to own or supporting my kids? You want to identify any opportunities that allow you to create a savings goal. And then you want to organize those priorities on what you think is key. And as I mentioned before, you want to automate your savings, create that automatic savings plan. My recommendation to you, and this may be a bit shocking, is to save for your retirement first before you save for your children's education. Because really think about it. The worst case scenario is that there's no money for the kids, right? But they can get a job. They can earn tips at a restaurant. There's also government funding as well. We can't rely on our children to be able to support us when we retire. So that's why we want to put our retirement savings first. Also, when you get to the savings level, as I mentioned, you want to do the automatic saving. So that's coming out of your on your payday, and then the money just disappears and it's set aside. And also think about what is the amount that you want to automate, right? Make sure that the amount you're automating is equal to the amount you want to save. For example, if you're wanting to save $2,000 for the year for a vacation, you want to break that down over the period of months that you're saving for so that it will equate to that $2,000 when you're ready to use it. And the other thing is the emergency savings fund. So a lot of you acknowledge that, and we recognize that we need to have emergency savings funds as well before our long-term savings is put into place. Um, we can say don't have emergencies, but emergencies are going to happen. So again, we want to be able to save for that. Also be thoughtful about having that buffer. And again, yes, emergency preparedness is really important. The next thing you want to do is have some level of sophistication about the types of accounts you're using. So I've mentioned these types of accounts earlier on in this workshop. And what you want to do is when you get to the next level after analyzing and committing to your cash flow is now looking at your savings. And you want to look at how do I build my investment portfolio? How am I now saving for those goals? Is it the saving for retirement or paying down the debt? And you're going to take a look at the TFSA and the RSP and how can you leverage those and make those work for you. Whether it's someone who's saving for a first time for their home, we know that the RSP registered retirement savings plan has an option for first time home buyers. So make these accounts work for you. Then what you want to do is as you become more comfortable with saving in these types of vehicles and TFSA and RSP, you then want to again grow your savings, grow your investments, move into the next level, which is mutual funds. And so then you're going into a more low cost, diversified type of portfolio. And again, don't follow the news and what the market is doing. It's going to cause you to start overthinking. Make sure that you put your monies and speak to a financial advisor and you're putting it into a portfolio that is suitable and comfortable for you and your needs. And then when you're comfortable there, the final level of the pyramid and generating that wealth and optimizing returns is then moving into something that is more risky based, whether it's market investments. So again, invest, don't be looking at what the market is doing. Don't obsess over it and what's outside of your control. Focus on the things that are within your control. And those things are fees, savings rates, the different types of diversification. Those things are 100% in your control. And then make sure that you're working with your advisor and ask what the fees are and what you're paying and that you've got the right plan in place so that you can set your goals up so that you're successful in that area. And then what I would also recommend is an annual financial practice. And there's two. The first one is completing a net worth statement every year. This allows you to start to see how you can build wealth over time. And it doesn't always prompt change, but it can reflect any progress that you're making. So just as we talked about budgeting, create a net worth statement. So look at all of the things that you have saved. List all of your savings accounts. List anything that in your goals and what you have set aside. So you want to list your savings, you want to list your debts, and you want to look at what the difference is of those two. And so again, it may not generate change, but it reflects the progress that you've made year over year. And the next really important thing is have a conversation with the people who are closest in your life, whether it's your spouse or your partner, or children, or even your parents. And what you're going to ask each other and have a discussion about are what are the things that you're going to do in 2024 that are going to provide you with more of the things that you love. And that will allow you to move forward with the things that are important to you, whether it's home or travel, those kinds of things. Have those discussions, really healthy discussions. Financial discussions are difficult, but it's important to understand what your goals are, whether it's as an individual, as a family, in a relationship, and so that you can set those goals, prioritize those goals, and put them into place. Another thing is I've been asked is, does a budget need to be strict? No, it doesn't need to be strict. You don't have to, budget to the exact penny, but you do want it to be sustainable and you want a budget to be realistic, right? And it doesn't always mean addressing the big things. Like it's not about the big car, it's not about the bigger home, it's about what your income permits. And again, it's really hard that when as a parent, not being able to provide, right? So if we've got a child who's showing a lot of potential and is being offered to be placed into rep sports, but we've got to pay that huge fee and it's not something that we can do, it's not within the budget. Those are hard choices that we have to make. Now we've got to look at where's the cash flow? How can we budget? Can we make this happen? Is it realistic to do that? And some other things to think about is there are scholarships that are available. There's even some low income funding as well. There's even some programs that are out there for kids who are wanting to take part in sports. So there's a lot of resources that are out there that we can tap into and that we can look at. Again, remember the ABC strategy, analyze, brainstorm, and commit for change. And finally, what is financial responsibility? So again, as I mentioned, as parents, we teach our children, and being able to teach our children and share this information with them is responsible. Not only is it responsible, but it's important so that we can help them take these principles and build that generational wealth and leave that legacy for them as well. Financial responsibility, at the end of the day, it just means paying your bills on time, not taking out more debt than you can afford. So again, spending less than you earn and being able to take care of yourself and those who depend on you. It means being prepared for the unexpected. So we talked about the emergency savings so that if you're hit with a financial liability, it will not ruin you. In order to be financially responsible, we need to live within our means. And to live within your means, you need to spend less. So being financially responsible means acting in your own best interest and do what's best for you and your family. And I'm going to leave you with some final words. Money is a tool. Learn to use it and use it wisely to build the life that you want. So think about money periodically, but think about it deeply and how you can make it work for you. So come to the end of the workshop. Was there any questions from anybody? Oh, I do see a question here. Are mutual funds similar to low risk stocks? They are similar. Again, it depends on the type of portfolio that you're choosing. So mutual funds, for example, if you chose something that was what we call a balanced portfolio, basically your money is being invested into different companies within that portfolio. So your money, we hear that term, not putting your eggs all in one basket. So there are a number of companies or organizations that your money's being spread and invested into. And depending on how those companies do, how they perform and how well they perform, you're going to get a return on that investment, but it may not be as risky, again, depending on that type of investment and type of organization. So yes, it is considered lower risk. So if you're looking at a balanced growth portfolio, that would be considered very similar to a low risk. Were there any other questions?
The new question just popped in the chat.
Okay, great. Does credit card debt affect mortgage renewal? That's a really good question, actually. In most cases, no, it does not. Because with a mortgage renewal, you would already have an existing mortgage with your financial institution. So if you're looking to renew your mortgage, you're basically just looking at renewing your rate, your term, and your amortization. So you're looking at the terms of your agreement on your mortgage. If for example, you're looking to renew your mortgage but refinance at the same time, so you're looking to consolidate some debt and work that into your mortgage, that requires a credit application. And then yes, your credit card or debt, as well as your credit score may impact at that time. But for a straight mortgage renewal, no, it will not.
I have a quick question, Sue. What about for students? I know when I was in university, like saving money, finances, it just wasn't a thing. We kind of like spent all willy-nilly. Is there any advice that you can give for students so they could prevent themselves from going into debt in the future?
Yes, that's a really good question, Tasia. And I recall that being a student as well. We are on tight budgets. So one of the things I would say is, we've got a certain amount that's set out for us, and that's where budgeting is very, very key. Try not to spend on things that are non-essentials. Um, you want to make sure that you're spending on those needs. So we talked about the needs and the wants. So that's number one. That's very key. Try to keep your expenses as low as possible. Budget, understand how much money you have to spend for the month. And sometimes we have to say no, we want to go out with our friends or we want to spend to go out to a restaurant. We may not be able to do that. It may just be instead, hey, come over to my place and let's cook a meal. That's a lot cheaper. Again, leverage any type of point systems that are out there that retailers are offering. So, it doesn't have to be credit card based. It could be something that it's just a point system. We know that there's grocery point systems, and there's even other retailers that offer that. Leverage those points when you're spending, making your money work. That's how you make your money work for you. Spend, earn those points that you can use those points and then redeem it for whether it's a gift card or for another purchase that you need to make later on down the road. So take a look at that and also keep that in mind. Um, and again, uh, in the economy that we're in and where inflation is high, sometimes it means that a hard choice of balancing studies and then maybe taking on a part-time job, and having to earn that extra income on the side. Again, it depends on personal circumstances and also student schedule, but sometimes it comes down to that. But again, I would say the basic fundamental is just being mindful of the budget and sticking to a budget, being strong with that budget and the decision that you're making.
And the next
There's
question in the chat here as well.
great. Okay. Latifa, thank you for your question. Should my car loan interest be higher than the actual loan? So for example, the loan is 30K interest. Oh, 30K and the interest is 40. That's pretty scary. And unfortunately, we are seeing instances of that in the economy that we're in with this inflation and the higher interest rates. Ideally, it should not be. Normally, that the interest rate that's being offered to you should not generate that type of interest repayment. But unfortunately, we are seeing instances of that, and that's where I would say negotiate, shop around, and try to see if you can get a lower interest rate somewhere else, or maybe look at another borrowing option. But again, your primary loan amount, so if your loan amount was 30,000, and then depending on what that interest rate is, that's normally how it's calculated. So the institution will take the 30,000 and then it's multiplied by the interest rate. And then over the number of years that you have to repay, and then that's added on to the loan. And that's what makes the loan jump up, the loan amount jump up. I hope that answers your question. And I do see another question in the chat. Is real estate syndication and crowdfunding a better option if you want property ownership without a mortgage? That's a really good question. Crowdfunding, it is a little bit of a risky option. And real estate syndication, it is newer in Canada. It is not a common practice, but it is an option that is out there. I would say research that one a little bit more. There is a lot of fine print when it comes to crowdfunding, and you want to look at the fees and the interest rates and any legal costs that are involved with that type of with crowdfunding. Um, it is another way of getting into the real estate market, but you want to look at, I've heard that after a certain period of time, there are then fees that need to be paid or requirements of the borrower. And you want to look at what is in your best interest and does that really work for you? Is it realistic? It's not just a matter of getting into the real estate market and getting into a property without having a mortgage, but at some point in time, you are going to be responsible for repayment or borrowing. And so, what does that look like when that time comes? What are the interest rate? What are the fees? And is that still going to be affordable for me in the future? Because again, the way the market is and how things are fluid, and now, is my situation, my financial situation still going to be the same then? And then can I afford that repayment when the time comes? Or is there an opportunity to renegotiate terms? Latifa, thank you as well. Um, I'm going to put up my contact information. So if there's any other questions that you have, financial questions that you have, feel free to connect with me after the workshop. I can be reached by email. I'm also on Instagram and Facebook and LinkedIn. So I'm happy to answer any questions that you that may come to mind after the workshop or that you weren't able to ask me this evening.
Thank you so much, Sue. I don't think, okay, there are no more questions. Again, thank you for the insight. I was literally sweating in some instances, especially when you're talking about retirement, mutual funds, all that stuff. I was like, oh, I feel like I'm so behind right now. But it's great insight. And for everyone who's still here, if you can please fill out our survey. Surveys are really important to us. It lets us know that you're interested in material, and also if you want to see more presentations like this from Sue. So I'm just going to post our QR code. So if you can scan it and just give us feedback on how you like the presentation, that would be greatly, greatly, greatly appreciated. So I'll just share that. Let's see. This is kind of acting a little wonky here.
And whilst you do that, Teja, I just want to say thank you to you again and Kajanga Wellness Project and to all the participants that were on tonight. I do appreciate you being here and joining and for your time and as well as being interactive in this workshop. And I hope that this information was useful to you and that you got some takeaways from this and that you're able to apply.